let's just pick up Trent and see what the stock price is up to. It's a significant jump that Zara India has seen in its PAT and revenues. Trent currently holding up 1.5% higher, 1,500 plus levels on Trent right now. Mayuresh Joshi as well joins in on the show. Mayuresh, I don't know how closely you've been tracking Trent, but it's never been a doubt about how much sales they can clock. It's always been about how expensive the stock is. But clearly, this is one company wherein the revenue and PAT growth seems to be defying, the valuations of the stock price. Still a buy for you at 1,500?
Afternoon, Aisha. So on the O'Neill lens, the momentum continues because it's on the it's above the pivot levels that we closely track. Again, as Vinny was mentioning, Zara's numbers have been very, very good. But I think the more critical component in terms of contribution comes in from West Side. That's almost 70% of revenues for Trent. And it's one of the most pragmatic business models that you can probably think of. The private labels probably extend itself in terms of both the margin performance that West Side individually contributes to the overall Trent margins. And the same sales growth have been in double digits, 10-11%. So the large expectation in terms of gross margins expected to be reasonable around that 48-49% mark. EBITDA margins between that 15 to 17% kind of a band will basically mean that the compounding that probably happens on the bottom line as discretionary spending holds up. Because apart from West Side, I think Zudio, which is the brand that they probably house, a lower ticket brand, has significant amount of sales growth as well. Add to that, Zara contributes to their JV as well. So yeah, I think second half should see significant amount of discretionary spending coming back as the festivities come through. And therefore, I think the momentum of this stock can very well continue.
Okay, so that's a take coming in on Trent and Zara, but I'm also intrigued to hear your views about mid-cap IT. Look at a Zensar Tech today. After that solid 12% rise in the week gone by, today again it's up around 12%. And even the numbers from other mid-cap IT companies have been quite strong. What are your top favorites here, Mayuresh?
Afternoon, Anisha. So, I think mid-cap IT companies have reported a very stable and a robust set of numbers. I think the large expectations after large-cap IT companies started reporting, and when Infosys probably gave that howler, is that mid-cap IT companies might also miss their mark. But I think across the spectrum, mid-cap IT companies have done exceptionally well. To take into account the ER&D companies, KPITs, and the Tata LXIs of the world. We probably look at LNT, LLTI, Mindtree, Zensar. You look at a very small company called Datamatics. I think none of these companies have probably disappointed at this juncture. So yes, I think the arguments that probably go in favor that even if the order book starts shrinking, mid-cap IT companies typically get order books between $1 million and $5 million in terms of a ticket. And therefore, I think those orders can very well continue in spite of an impending slowdown. BFSI, which is obviously a big contributor for the sector as a whole, can see some imminent headwinds and manufacturing out of the European zone as well. So I think the first quarter numbers are going to be very, very interesting this fiscal round on what is the reported number in terms of both constant currency revenue growth as well as the order intake. But so far, I think mid-cap IT has not disappointed. I'll probably wait for pullbacks, Anisha, to answer your question. A few of these stocks in late-stage basis as per the O'Neill methodology, and therefore waiting on pullbacks for a stock like a KBIT or even something like an LTI Mindtree, persistent for that example as well. So both these or three of these counters, maybe pullbacks is something that I'll probably look at because valuation will also become a tad bit more reasonable.
Mayuresh, if you had to buy afresh within auto anchs or autos, what would you pick?
So Aisha, I think tire stocks are looking very interesting. You just mentioned MRF, and most tire companies have reported a very stable set of numbers. Margin expansion was very, very robust because input cost deflation had played out in terms of the P&L, and it's still expected to play out quite meaningfully for the better part of this financial year. Natural rubber prices are significantly down, expecting it to hover between 155-160 rupees per kilogram. Synthetic rubber prices, NTCF prices are all down because crude derivatives are expected to be lower. Having said that, the expectation in terms of volume growth, both from the OEMs and where stable demand is expected to continue, both from a volume and a pricing perspective for the replacement market, that should probably hold up the fortune for these players as well. So within the pack, obviously, I think MRF has done exceptionally well, but it's a large ticket item. I think Apollo Tyres looks very, very interesting. Numbers with margins at 16% were very, very robust. Even if they normalize to a certain extent in the next few quarters, a large part of the capex is largely behind them. The management believes, Redstein, the European operations, another 10 or 12 million tires can probably go through in the European market in the aftermath of the Russia-Ukraine crisis and the ban on Russian imports as well. And that creates a significant addition for its European operations. And even within the domestic scene, MHCV, PV market are expected to hold up pretty well. So I think in the auto space, as you specifically asked, I think tires look very, very interesting. Apollo Tyre within that looks very, very interesting.
In fact, Mayuresh, this entire luxury segment is something that we have been talking about. We just spoke about Trent, Zara. Now you have Ethos, which reported a decent set of numbers, though the valuation is definitely expensive. And then you also have names like Landmark Cars, maybe a Vedant Fashions, etc. as well. Any topics?
So I think all of them have moved significantly, Anisha. You're absolutely right. I think we'll have to wait for pullbacks. Even the case of Ethos, as the management was just speaking to your channel, I think the move before the results, I think they're almost 45-50% kind of a move. It's very interesting because the luxury market, if you look at the watches segment, specifically the premium and the super premium segment, the expectations of the market size moving from 6,800 odd crores to almost 12,500 odd crores over the next few years seems to be plausible. And within this, I think the premium and the super premium segments, through the offerings in terms of EBOs and specialist stores, is obviously going to expand quite significantly. I think Ethos becomes a huge component in terms of the entire ecosystem there. But valuations, as you said, are exorbitantly high at this point of time. The move already was gestated in before the numbers. So I think we'll wait for significant pullbacks on this one as well. And even the premium end of the car market, you have a look in terms of the sales that the premium end car makers are probably reporting in the Indian context itself. And that number is expected to grow exponentially as disposable and discretionary spending keeps on going higher, specifically in the urban and the semi-urban side as well. So yes, I think some pockets of the market expected to do well, but would expect, again, pullbacks because I think it's a little bit overheated at this point.
L&T saw a bit of a sluggish performance after its earnings as well. In fact, the entire capital goods space, the numbers have been quite solid apart from L&T, and the street was baking a lot in for L&T. What's your take, Mayuresh? Is L&T a still good buy, or maybe you should look at the likes of ABB, Siemens, Thermax, Cummins and the likes?
No, absolutely. I think most of these players have given a fabulous set of numbers. So I think whether you take into account ABB, Siemens, Cummins, they were on our buys a few weeks back, but the moves have been quite significant in these counters. To that context and contrast, L&T probably disappointed in terms of the margin profile. But the management sounds very, very hopeful in terms of their objectives from an FY26 perspective. The three objectives that they've probably laid out, one in terms of the ROE targeting of 18% over the next 3 to 4 years, with expectations of 14% to be hit in the next year itself. So they're almost around 12.2, 12.4% at the end of 23. So I think 14% will be a huge jump in terms of the operational capabilities for L&T itself. The second element in terms of getting the working capital requirements down quite significantly will mean that cash flow improvements on the balance sheet and ROICs and ROEs, both of them improving in that tandem as well. And the third and the most important aspect in terms of the order book that they've probably got, with input costs now coming off quite significantly, my own expectation is that L&T's numbers should sequentially look and appear far better. Obviously, I think you're talking about general elections in the first quarter of next year, and therefore a lot of pre-ordering will also start coming through in the next 2 to 3 quarters. So the hope is still around that L&T should continue doing well on operational efficiencies, but the other firms have done well. So yeah, I think L&T should do well in the next couple of years.
Right. Mayuresh, just let's have some buy calls from you as well, stocks that we've not spoken about.
So NBFCs, Ayush, as a space look very, very interesting in our opinion. In most logical terms, I think the rate hikes largely behind us, which means that the rate curve should probably start tapering off. So I think the NIM compression would be a little bit obvious in the first half of this financial year, but I think it should start flattening out and making a case in terms of more stability there. In terms of the retailization in terms of L&T Finance, more specifically on the NBFCs that we're looking at, and Sundaram Finance. Obviously, Chola also remains one of our top picks. But for L&T Finance in general, in particular, retailization has hit 75%. Wholesale drawdowns of 11,500 crores in Q4 is a significant amount. The expectations of OPEX staying below 4%, credit cost staying below 3%, GNP is below 3%, and net NP is below 1%, will mean ROA expansion to 2.8 to 3% as per their targets, which is easily achievable in the next few quarters and years. And therefore, I think the kind of valuations that it is trading at this juncture and the expectations in terms of significant growth with tier 1 capital at 22% will mean that earnings growth should outbeat expectations and estimates, at least over the next few quarters. So I think NBFCs as a space look very, very interesting at this juncture. L&T Finance, Chola, Sundaram Finance look very, very promising.
Right, okay. Let's begin winding up the day then. Mayuresh, good to have you on the show as always.